Welcome back. You're watching India Today, and we're bringing you the biggest voices on what to expect in Nirmala Sitharaman's budget. If you look at the clock, 3.5 hours left for that presentation. But we have with us Jeff Dennis, emerging markets commentator. Welcome to the show, Jeff. And I'm going to start with the biggest question that all market participants are looking out for. What do you expect the government of India to be doing as far as the fiscal deficit is concerned? We've seen slippages. This year's target of 6.8%. We've had a very healthy revenue uptake, but disinvestment has not been that good. So what are your own expectations as far as the fiscal deficit is concerned?
Well, I think we must expect the government to target a lower fiscal deficit for fiscal 23. In other words, probably around the 6.3% level, certainly lower than the year just ending. And of course, that's going to be focused on by the market because the fiscal deficit has been, as you rightly say, has been disappointing over the last few years generally. Fiscal policy has been far too expansionary. This is, of course, as you say, this has been the case in the current fiscal year, despite very, very strong revenue growth. And are we going to get that same revenue growth again in the following year? Therefore, within the budget, I think what are going to be the key issues are going to be: are we going to see any proposals in terms of new structural reforms, which could obviously boost the budget situation down the road, but also investors will focus very heavily on what the disinvestment target, the privatization target is going to be in terms of numbers for the new fiscal year, because it's very important to fill the budget deficit gap, and also because, of course, the disinvestment revenues were so poor, so disappointing, have been so disappointing in the current year.
Jeff, I want to get a sense from you. Yesterday we had the economic survey tabled, and they talked about how high forex sustained FDIs, so high forex reserves, sustained flows, as well as rising export earnings would all help as a buffer against tapering, against gradual tapering that is, of course, anticipated. How do you feel some of these elements will play out, and what do you also feel will be the likely impact on currency, particularly the rupee, as that's also a pain point here?
Yes, it's actually been a very impressive performance by the rupee. I think over the last several months it's remained very stable. It's been short-term volatile, but basically the trend has been pretty stable against the background where a number, of course, of emerging market currencies have been weakening in recent months. Now, going forward, I've long thought that the Fed was going to be quite aggressive on interest rates. I've long thought they were going to raise rates by three to four times this year. Now, maybe they do a little bit more than that, but for sure, as of March, they're going to start raising rates. The tapering process will be over. So in a sense, they're going to stop buying any more securities at that point. Then, of course, we're going to focus on when they start to run off their balance sheet. But come what may, we're going to end up with a much, much less accommodating Fed. I think pretty aggressive tightening in 2022 until we start to see a significant downtrend in annual inflation. And with that runs the risk, I think, of the dollar staying relatively strong. And if the dollar stays strong, I think it will be hard for emerging markets generally to attract a lot of new money. Now, India, I think, is not a special case, but India is in a good place relative to a lot of other countries like a Brazil or a Russia or a South Africa or a Turkey. His policy is reasonably good generally. Currency's been stable. And so I don't see India suffering dramatically from that point of view, but you do have to watch the dollar, you do have to watch the Fed. And in the event the dollar does go down this year, which it might do because people get nervous about US assets generally, well, then money will come into the Indian market. And so I think you watch the general performance of the dollar and you watch what the Fed is going to do, but you are against the background where you've had a very good, stable performance by the Indian rupee over many months. And that's pretty good in this emerging market environment.
Jeff, we've spoken about the rupee. I want your thoughts about how oil prices are likely to behave. And it's become a concern There's a build-up that's happened as far as global crude is concerned. In India, for the last 2.5 months, near about 3 months in fact, the companies, oil marketing companies haven't passed on the price increase and there was an excise cut. Could oil become a source of worry for the fiscal math in the coming financial year?
I think it could be a source of concern for the economy. Now, clearly, I think there's 2 points there. As you say, if you're not seeing the oil price increases so far being passed on, well, ultimately that could happen, and that will boost inflation. Now, what you've got in India is you've got negative real interest rates, not dramatically so, but you've got negative real interest rates, obviously, with inflation running between 5 and 6%, and so. What that might do if you start to see inflation ticking up because of oil, you might see more pressure being put on the RBI to take some of the burden of this adjustment by, at some point, increasing interest rates. Now, having said all of that, I generally believe, and this is not a consensus view, that with the global economy likely to slow down in 2022, calendar 22, in the US and a lot of other countries, partly because of the Omicron variant at the start of the year, partly because some of the fiscal support for some of these countries will be gradually or quickly withdrawn. I think you're going to see oil prices probably start to trend down at some point later in the year, and that will provide some relief for India without any question. So I would view stronger oil prices from here as not a base case, but as something that is a risk for India. I think the base case down the road is probably that oil prices level off and maybe even start to come down. I think that will provide some welcome relief for Indian inflation and for the economy.
All right, let's also bring in some other views in terms of the key expectations. Rhythm Desai, MD Morgan Stanley, shares with us some of his views. He's also watching out for any announcements on the global bond indices and any kind of issuance the government's looking at there. He also spoke about the LTCG and said that it would be most unpleasant if it was hiked to 15%. Those were a couple of the takeaways. Let's also hear out some more of his expectations.
If you look at the past 30 budgets, and that is as far back as I go, because we start from 91, 92 onwards. The 2 out of 3 times the market has gone down in the 30 days after the budget, irrespective of what the budget has done, irrespective of what the market has done prior to the budget. Now, if the market goes up before the budget, so it's trading up in the days prior to the budget, then the probability of it falling rises to 80%. So essentially, you're dealing with a situation where the market invariably tends to sell off post-budget. Now, this is purely short run. Budgets, I think, should be viewed beyond their impact on stock markets on a 15 or 30-day basis, or even a 3 or 4-day basis. And I think we should lay more emphasis on the strategic shifts that happen.
Another important market voice, Ramdev Agarwal, a veteran of the markets, had this to say.
If you see the indirect taxes, already GST is happy throughout the year. So there's not much to see in as far as the indirect taxes are concerned. In direct taxes, if you see the corporate taxes at 25 and 15%, I think you can't ask for anything more, except that at the margin, some incentive could be there, PLI kind of thing for further investments. But I don't think the earnings growth cycle is going to come up because of any kind of budgetary support.
Well, the SGX is indicating a positive start. Remember, in 21, we had one of the biggest single-day gains on the index post the budget. This is clearly, what the market's waiting to hear. The headline figure of growth, the headline figure of what the government is aiming for on the fisc. And even in the previous budgets during the worst of the pandemic, the idea was as long as they really stuck to the path, Siddharth, they didn't really have any major shocks. And while they didn't burgeon the fisc, at the same time, they did sort of comfortably relax it.
Abha, that's a very important point. I think the markets and other participants have been forgiving of governments, not just in India, overall, when it comes to fiscal slippages due to the pandemic. Will they continue to be so? I think the voices that we heard, including Jeff and other voices, seem to be saying that that road will probably have a red light coming up very soon. But another view, and this time from a policy maker from India, the chairman of the Standing Committee of Finance in Parliament and former Minister of State for Finance, Jayant Sinha, had this to say when it comes to the budget.
When the Finance Commission and other expert groups have looked at this topic, they have said that the right debt to GDP level should be at 60%. Right now, we've reached 90%, and that's largely happened because of the COVID pandemic, where we've had to spend a very significant amount of money and take our fiscal deficit from 3%, 3.5%, which is where it normally is, to 9.5% and 6.8%, and so on. That obviously is going to mean that the debt to GDP is going to increase. And the more that increases, the more rates go up, then the more pressure there is on government expenditure. Those are the dynamics, the debt dynamics that we have to be watchful of. And I'm sure that the Honorable Finance Minister, the Honorable Prime Minister completely understand these debt dynamics and are going to be very prudent and thoughtful about what expenditures to incur as a result of that. And that's why it's even more important for us to have investment-led growth, which can drive sustainable growth in the long term, and that can then bring down the debt to GDP and reduce the pressure that government is facing on that account.
All right, so what are some of the key themes that the budget will focus on this time around? The thrust, of course, likely to be on capex. That's the big buzzword in order to support growth. To fuel recovery, infra could be the main focus. Let's bring up some of those key points for you. Boosting infrastructure, capital goods, capex push, that's really going to support growth going forward, and that's the big expectation. Now, where can the government do this? They can do this on rail, they can do this on roads, they can do this defense. So, you know, real estate, SOPs to boost investment in real estate might be key as well, playing the infrastructure theme. Cement will be a big beneficiary of that, so that's the other expectation as well. So watch out for real estate, watch out for any SOPs also announced separately on the tax front on real estate as well. Capex push will also support growth in capital goods. They'll obviously benefit from the infra theme as well. So we've got real estate, cement, capital goods, infrastructure, that entire basket or gamut of stocks are going to be in focus coming in today. Infra is a big theme. Auto, of course, job creation in order to drive sales. Now, this comes under, also manufacturing. And while PLI schemes, more than 20 have been announced already this year, but clearly there'll be more, incentive that's required there. Duty cut to spur margins when it comes to the metals pack. And remember, metals have really been going from strength to strength on the exchange, burgeoning demand, of course, rural stimulus will also be the need of the hour. Now, this is a pain point, and this is really where the government can score some marks, because rural stimulus and the consumer, especially at the lower end of the spectrum, has been suffering in terms of disposable income. They've been feeling the pinch. So really, what can the government do in order to create more disposable income, create more spending? And a lot of your companies, such as Staples, FMCG, they're likely to, of course, benefit on account of anything that's announced on that front. So those are a couple of the themes that we're watching out for. Quite a gamut, Siddharth, from infra to real estate to what we're watching out for on prices, because we've seen that spike in input prices across the board, and then, of course, staples.
The union budget accounts for less than 10% of our economy. 90% is within the states, but it talks more about everything. But there are more views that we have for you as far as the budget, the direction, and the overall economic policies. And we had two of the senior-most economists from India, Arvind Panagaria, former Vice Chairman of the Niti Aayog, and Kaushik Basu, former Chief Economic Advisor in the Ministry of Finance, talking about their views. Take a look at that face-off.
India, from 2016, every year's growth has been less than the previous year's growth, which has not happened in India ever since 1947. A 5-year run where each year is lower than the previous year.
So last 2 years, what kind of economy did the UPA hand over to Prime Minister Modi? The last 2 years of UPA, below 6% growth. What was the growth rate in the first 5 years of Prime Minister Modi? 7.4%.
The employment situation for the worst off people, for the farmers, for the workers, for small businesses across the board it's a very, very difficult time. Barring the people who are at the top end for India, it's a very difficult time.
If you look at what has been done on the social expenditures, it's way ahead of previous governments, actually, in terms of, well, first of all, money that is meant for the poor goes to the poor. It's not leaking.
Are interesting points of view and clearly very, very diametrically opposite. But let's go back to Sajid. Sajid, what can this budget do for job creation? That's the biggest issue. That's the biggest political issue. And in the recent past few weeks, we have seen considerable stress building up on that point.
Job creation is an issue all around the world. Coming out of a pandemic, even the US, we still have about 3.5 million fewer jobs compared to where it was before the pandemic. Jobs are certainly a challenge in emerging markets and in India. And I think this is happening for a couple of reasons. One is, in many parts of the world, the pandemic has accelerated the transition from the informal economy to the formal economy, which tends to be more capital intensive and less labor intensive. So you can produce the same output with fewer jobs. The second is, because of this transition from informal to formal, you may have a skills mismatch opening up. So there's excess labor in the informal sector, but the formal economy is growing. They want a certain kind of worker, and sometimes that skill type is not available. So this is both an issue of creating enough jobs, but also of ensuring that the skill mismatch is mitigated. Now, what can the government do? My sense consistently for the last couple of years has been job creation is not easy, but what we can do is public investment. And I think this has been the government's focus. We saw in the pandemic year a capital investment. So if we look at capital expenditure in the budget, rose from about 1.6% to 2.1%. The target was even higher in this fiscal year that's ending, and I hope the government can meet that target and set higher targets next year. So I think the near-term focus has to be, if there is more spending on infrastructure projects, on health, on education, that will create jobs. The second advantage of that is if you have a sustained public investment push, right? Hopefully, over time, that will crowd in private investment, and then private investment will create jobs. So this is going to take some time, but I think the budget has to be a catalyst for a big, sustained infrastructure push for job creation.
Mr. Virmani, what about jobs? Let's focus on that for a moment. And is there merit in an urban Narega kind of scheme that's being much talked about?
I think we have to be very careful about the temporary effects associated with the pandemic, which is a very special. It's like a once-in-a-century shock which has happened. And we should not generalize too much. It's not reflected of the normal economic shocks that we have faced, let's say over the last 50 years, or are likely. Of course, there could be climate shocks, etc. But leaving that aside, the normal economic shocks, I think the issue with the pandemic was that, and this we said, and nobody believed us. We've been saying, because we've done the research on pandemics, we said that it's more of a problem in urban areas, because the virus, because it spreads through the air, it spreads through close contact, and these situations arise more in the urban areas. The pandemic will spread faster than the pandemic in the urban areas and will have more negative effects. We've been saying this for a year or year and a half, but nobody kind of believed us. So the conditions are special. The severe effect on urban employment is due to this very special factor. Now, I think it would be a mistake to overplay that. Of course, there will be some situations where we have some new epidemics, but this is not the problem in general with every shock. So I think some attention needs to be paid to that, but overdoing it, I think, would be a mistake.
Well, that's an important point. But coming to you, TV Narendran, as far as the higher medical expenditure due to the pandemic and costs that have gone up for people, what do you think? Should the budget be providing some sort of relief when it comes to more exemptions on medical insurance and the entire gamut of expenditure that people have had to suffer?
One needs to look at it in the overall context, because if you look at it from the government's perspective, they've spent far more on vaccination than they had planned to, right? By providing it across the country. So, and now with the booster shots, etc., there are a lot of expenses the government is directly incurring, which would have otherwise been incurred by the businesses, corporates, or individuals, right? So the government needs to see how is the money best used in the most impactful way, so that it reaches all citizens, and more so. Yeah.
So Narendran, do you also support the case for further tax relief, given the government has managed to secure, far more revenues on the back of fuel taxes, GST, and we all know the record collections we've been seeing on that front?
No, I'm not arguing against that. All I'm saying is that, one needs to look at how much of money the government needs to spend on what, and if it is first ideally spent on vaccines, then it should spend it on vaccines before it gives the tax relief, because the tax relief is also relevant only to a certain section of society, whereas vaccines are relevant to all sections of society. And I think, to be fair to the government, till 3-4 months back, they were also not clear how much will be the revenues vis-a-vis the expenditure. I think the GST collections have been great. The recovery has been strong. Tax revenues have been strong. That probably gives the finance minister more headroom to maybe pursue some of the ideas that you're suggesting. But certainly the fiscal health looks much healthier than it was maybe 6 months back.
Well, those expectations are clearly going to be right up there. And as we count down, we're going to slip into a short break. Stay with us, and our guests will also be here as we come back with more coverage on the budget.